So the volatility in the stock market over the past few weeks is threatening both corporate profits and economic growth, but the biggest dangers may lie in the bond market. We're talking about corporate debt. Will the coronavirus trigger a corporate debt crisis? Let's bring back Sheila Bair, former FDIC chair. She's joining us on the telephone, and you have for over a year been warning people about problems in corporate debt and with leveraged loans. What, if anything, is concerning you right now as we're trying to steer through this latest issue in financial markets?
Right. Well, the corporate bond market is under stress, and we have a lot of companies that are BBB rated that are in the territory of easy downgrades into junk status, which would make it much more expensive and difficult for them to access credit through the capital markets. So I do think this is an area where government, in particular, the Fed in particular, should be focused. I think Eric Rosengren had suggested last week that they should be looking at non-financial corporate bond purchases. I think that would send a very strong signal. There is also authority under something called 13.3 to lend directly to non-banks with the approval of the Treasury. It needs to be they need to be facilities of general eligibility, so they can't pick winners and losers and say, okay, we're going to bail out United, not American Airlines or whatever. So, and that's appropriate. But I think those are tools that they can and should use. I do think there's some parallels to some important differences between now and 2008, but I think one thing we did learn in 2008 is that bailing out the banks is not really a very good transmission mechanism to getting the support out to the real economy, and so some direct intervention to make sure credit continues to flow to the non-bank sector is important.
Hey, Sheila, it's Brian Chung here. Now, the things that you just mentioned with regards to buying corporate bonds or maybe getting approved from the Treasury, they would require an act of Congress or coordination with the Treasury. For right now, it seems like the Federal Reserve is trying to go it alone, at least with their repo operations and also with their asset purchases, which they just announced would include those on the long end of the curve, buying 30-year bonds, for example. I'm wondering what has been your read on the Fed's injection of over $1 trillion in repo yesterday, which isn't necessarily a direct loan per se, it's providing liquidity, but I'm just wondering what you think about that option. Is that really going to do much to calm the turmoil so far?
Well, I think they need to do it. I support their doing it. That is money going into the financial sector, primarily into the banking sector, but we also want to make sure that banks remain liquid and they do not pull the credit lines. They did that in 2008, pulled something like $3 trillion in credit lines, which had a very bad impact on the real economy. So keeping the short-term funding markets liquid and open and operating, it's necessary to keep the banks liquid, to keep the credit lines open, but also, frankly, to keep the government debt machine going. They're monetizing the government debt at this point. I don't like that either, but I think in the near term they absolutely have to do this. The plumbing is not working unless the Fed we saw the canary in the coal mine last September on this. So keeping those short-term funding markets liquid is essential. I think they did the right thing on that. But that by itself is not going to be enough. That'll keep the banks liquid. Hopefully will keep them from pulling credit lines. But there needs to be greater direct access in the non-financial corporate sector to credit, because I don't think the banks have the capacity or the willingness to do it. And so I think that the Fed will need to directly intervene. And you're right, they do need approval for Congress to do bond market purchases beyond what they have authority to do treasuries and GSE debt and MBS. They don't have authority to go beyond the non-financial sector, so they would need approval for Congress. But that would be a good thing to have in whatever stimulus package Congress comes up with. And then 13.3 does not require legislation. They can get approval from Treasury to do that.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.